This. Brock University acknowledges the land on which we gather is the traditional territory of the Haudenosaunee and Anishinaabe peoples, many of whom continue to live and work here today. This territory is covered by the Upper Canada Treaties, and it is within land protected by the Dish with One Spoon Wampum Agreement. Today, this gathering place is home to many First Nations, Métis, and Inuit peoples, and acknowledging reminds us that our great standard of living is directly related to the resources and friendship of Indigenous people. Good morning once again, and welcome to this session of Business Readers. It's a live webinar series hosted by Goodman Group at Brock University. My name is Abdul Rahimi, and it's my distinct pleasure to serve as the director of Goodman Group here at beautiful Brock University. Goodman Group is a community-focused learning and development services provider that works to support professionals, businesses, entrepreneurs who are pursuing growth through professional development certificate programs, executive education, consulting services, and support for our many of startups, both on campus and within our communities. It is my distinct pleasure to welcome you all to today's sessions as you're taking a break and joining us today. This webinar series aims to provide 45-minute readers filled with insightful discussions on timely topics that are relevant to businesses and everyday lives, led by award-winning Brock University faculty and leading industry experts, encouraging thoughtful debates while keeping us all feeling connected. Momentarily, I will introduce our distinguished speakers for today's session, and thank you all for those of you who have submitted your questions at the time of registration. For those of you that are watching live now, you're encouraged to type in your questions into the chat feature, which is open now. And for those who are watching the recording, you can email us your questions, and we'll do our best to get those answered, either directly or through subsequent sessions. Now, it is my distinct pleasure to introduce our panelists today. I'm going to start us off by introducing Professor Ernest Biktimirov, who is a chartered financial analyst and professor at Goodman School of Business. He has taught courses in corporate finance, international finance, and research methodologies in finance as well. At Goodman, Professor Biktimirov has served as the Associate Dean of Research and Graduate Programs for a number of years. He has been a faculty advisor for the Brock Finance and Investment Group and an advisor for the CFA Institute Research Challenge Competition. Prior to his academic career, Professor Biktimirov worked as a research engineer at the Institute of Cybernetics of Uzbek Academy of Sciences, as well as assistant computer system manager at the University of Kentucky. Professor Biktimirov's papers have won the Best Paper Award at several conferences, both here locally in Canada and also internationally. He has also been the recipient of numerous teaching awards, and he's often quoted in Canadian media such as the Globe and Mail, the National Post, Canadian Business, and the Business News Network. Our next panelist is AJ Vance, who is a seasoned professional in multi-residential real estate development. After completing his Bachelor of Applied Sciences in Civil Engineering, he has been working for over 8 years in the private sector. AJ is currently working as the development manager with LIM Developments, where he oversees the full development activities for over 20 projects in over 15 municipalities in the Golden Horseshoe regions. Our next panelist is Shaheryar Mian, who leads the business development at LIM Developments, a real estate development firm which is based in Burlington, Canada. And prior to joining this organization, he worked in banking consulting in London, UK, and New York over a decade in the early part of this century. At LIM, Shaheryar oversees development of a number of residential condo towers in Southern Ontario primarily, leading the phases of acquisitions, planning, and marketing. He also invests in real estate assets in Canada and abroad. It'd be good to get some insights of those investment tricks and trips from you, Shaheryar, on both accounts. Our next panelist is Ms. Robyn Brown, who's an urban planner and professional land economist at IBI Group with over 15 years of planning, economic development, and ICI market experience. Ms. Brown, as director and senior practice lead in real estate economics and planning group, leads a group of planners, economists, and GIS specialists using her extensive knowledge and expertise in the real estate market to assist clients with their planning and real estate needs. Ms. Brown's work at IBI Group includes market, economic, and development feasibility studies for public and private clients across North America, Europe, and the Middle East. Ms. Brown currently serves on the board of directors for Toronto CREW and Association of Ontario Land Economists. Previously, she was on the management board at ULI. Good morning. Thank you for being here. Welcome, Robyn.
Hi, thank you very much. I'm just going to share a few slides here. Please let me know if my screen is sharing properly. Can everyone see that okay?
Yes.
Great, thank you. So very excited to be here. Obviously, these are our bios. I'm going to just start to talk to you a little bit about sort of the fundamentals around, what really drives real estate, and that's obviously growth. And recently, the StatsCan has put out the most recent census. This is 2016 to 2021. And if you look at Niagara region, the massive amount of growth was in Thorold. Port Colborne did well, and all of these growth numbers are higher than the Ontario average. So really, Niagara region has been growing substantially. This has a lot to do with the supply of land, the supply of housing. So this is a very important sort of understanding that this area has been growing and there's a substantial amount of demand and opportunity. And what is this really driven by? Well, a great deal of this will be driven in the future by immigration. The GTHA is expecting 4.2 million immigrants to the area between 2021 and 2051. This will result, along with natural growth, in the need for about 92,000 new residential units in Niagara region and 85,000 jobs. That's about 2 million square feet of office development. So this is a very important factor when you're thinking about the city's growth and the cities within Niagara region and the region itself. So where is this growth going to go? So right now, the Niagara region is doing their municipal comprehensive review. And what that does is it establishes where and how the region is going to grow, where the jobs are going to go, where the people are going to go. And these are focused around certain areas: urban growth centers, intensification, transit areas, there's greenfield growth. So there's a variety of growth, and particularly in Niagara region, which has a very diverse municipalities. You see it in different places. So when you're looking for investment opportunities, it's very important to look at where demand is. And you're going to see a lot of demand within Niagara region. As other municipalities and regions become more expensive, land becomes more expensive. There's a scarcity of land in many municipalities where I build out with the Greenbelt. There are quite a few opportunities in Niagara region. So this slide here is just going over where the growth is going to go. St. Catharines is looking at the majority of the growth. This is in part because St. Catharines has what is called an urban growth center. That is a policy that the government has put in place, the Ontario government, that looks at these urban growth centers, which is to intensify areas around transit, community services. So really, you're seeing the majority of growth will be in St. Catharines, Thorold, Welland, Pelham, and Fort Erie. And Niagara Falls also has an urban growth center. So again, a substantial amount of growth and jobs. So when we're thinking about where to invest, these are the kind of areas that are expecting growth, will be planning for growth, and have the services to accommodate growth. So I'm going to pass this over to Earnest, who's going to talk a little bit about real estate investment.
Yeah, thank you, Robyn. So in addition to the direct way of investing in real estate by purchasing a house or a condo, interested investors can add real estate to their portfolios by purchasing publicly traded securities like real estate investment trusts, referred as REITs, exchange traded funds known as ETFs, and also mutual funds that invest in real estate investment trusts. And before I discuss each of these type of securities in detail, I would like to highlight the benefits on the next slide. One of the first benefits of investing in real estate through publicly traded securities is their high liquidity. If you decide to buy or sell a house, it can take you several months to complete your transaction. In contrast, real estate investment trust, ETFs that invest in real estate investment trust, they're traded like stocks. So they can be bought and sold multiple times in a matter of during the day at a fraction of the transaction cost of buying and purchasing a house. In addition, they offer broader investment opportunities because there are real estate investment trusts that invest not only in residential real estate. You can invest in the office space, you can invest in healthcare facilities, you can invest in the hotels, motels. So investment opportunities significantly higher, both in terms of the type of real estate and also in terms of the geography. So basically you can invest in the real estate properties that are located not only in Ontario, but also in Quebec, also in Alberta, for example. Now going to the next benefit, diversification. everybody knows the golden rule of investment. Don't put all eggs in one basket. And investing in these publicly traded securities offers instantaneous diversification because your money will be spread among a large number of assets, among a large number of the real estate properties. Like, for example, you can start your investing with as little as $100, and basically your $100 can be spread among 100 different residential properties located in several provinces. In addition, another benefit is professional management, because real estate investment trusts, ETFs that invest in real estate, they're managed by professional managers who have the required expertise, training, and resources in order to make the purchasing and selling decisions. So you don't need to make these decisions yourself. Another advantage is small investment size. If you decide to invest in real estate directly, it requires significant capital. In contrast, you can start investing in real estate through these publicly traded securities with as little as $50. Another big advantage is divisibility. What do I mean by that? Like, for example, if you invested in real estate and then 2 years down the road, you need 10% money of your back, you need cash in order for some of your expenses, for some of your needs. You cannot sell like 20% of your house, but you can reduce your real estate investment portfolio, which is invested in publicly traded securities, at any percentage. You can sell 10% of your portfolio, 15% of your portfolio, and then when you need again have extra cash, you can easily again add additional cash to your portfolio. Another advantage, the last advantage that I would like, it's the last but not the least, it's tax advantages of investing in real estate through publicly traded securities. Because all these real estate investment trust shares, ETF shares, they can, or mutual funds, they can be held in your registered retirement savings plan or in tax-free savings account. And in this case, you will not need to pay any tax on capital gains or any tax on the dividend distributions. So taken together, we can see that investment in publicly traded securities offers significant benefits that are worth considering. And now I would like to talk on the next slide regarding real estate investment trusts. In Canada, we have 39 real estate investment trusts that are traded on the Toronto Stock Exchange, and they offer attractive yields, monthly dividends, and long-term capital appreciation. And on the chart on this slide, you can see the distribution across different sectors of real estate that we currently have in these 39 real estate investment trusts. And we can see that the largest portion on the left in this purple color, it's a real estate that provides diversified investment. So by purchasing this real estate investment trust, you basically will be investing in the different types of residential properties, different types of real estate properties. Most likely it will be residential real estate, retail real estate, and so on. The next two big groups of sectors there in which real estate investment trusts invest, it's a residential real estate, it's on the top right in the red color, pink color, and then in the blue color, it's retail real estate, and which is followed by the industrial real estate. So you can see these 39 real estate investment trusts that are traded like regular stocks. They can be bought and sold multiple times throughout the day. They can offer broad scope of investment in different sectors of real estate. And now let me talk about the exchange traded funds. Currently in Canada, we have 6 exchange traded funds that invest in real estate investment trusts. So you can see the names of the providers and the tickers, because real estate ETFs, they're also traded like regular stocks throughout the day. And unlike real estate investment trust, ETFs invest in the basket of securities. So they provide an extra layer of diversification. So ETFs usually they own at least 10, 15 of real estate investment trust or companies that finance real estate. And they offer monthly or quarterly distributions. Yield ranges from 2 to 4%. And if we look at the management expense ratio, the cheapest among them will be Vanguard, that uses ticker symbol VRE. And then on the next slide, I will simply just would like briefly to talk about this exchange traded fund as an example. So this Vanguard FTSE Canadian Cap Real Estate Index ETF. So it invests in 16 stocks. Majority of these stocks are real estate investment trust or companies that provide real estate services. And you can see on the right side, you can see the sector weighting. So we can see that these exchange traded funds invest in real estate sector, residential sector, in the office space, in industrial REITs, and also in diversified REITs. And again, in these ETFs, it's traded like regular stocks throughout the day, and it provides the instantaneous diversification by investing in 16 different stocks. And now on the next slide, I would like to talk about real estate mutual funds. If the other types of securities that I just discussed, real estate investment trust and ETFs, they're traded like stocks. So in order to be able to invest in them, you need to have a brokerage account. However, if you decide to invest in real estate mutual funds, you don't need to have a brokerage account. You can simply just go to your local branch of the bank and simply just ask them, okay, for the real estate mutual funds, and probably they'll be able to offer you several options. And then you can start investing in them with as little as $100 or $500. And these mutual funds, again, they also will offer instantaneous diversification because they will be investing in the real estate investment trust and also in the usually companies that finance real estate through the that invest in different sectors of the real estate and also located in the different geographical areas. So they provide distributions quarterly or annually, and their management expense ratio is higher compared to the real estate, compared to the exchange traded funds. Like remember, Vanguard ETF expense ratio was 0.35%. In contrast, real estate mutual funds have higher management expense ratio that ranges typically between 2 and 3%. And so taken together, we can see like there are several opportunities to invest in real estate. In addition to direct investing, you can invest through the publicly traded securities, like through the REITs that invest in the companies that manage, own, or finance real estate. Or you can invest in the securities that provide you like basket of securities, like ETFs or mutual funds. And they offer several benefits that I just discussed. And so if there are any questions, again, I will be more than happy with my colleagues to address them.
Thank you very much. Yes, we do have a number of questions, which is great. Perhaps one here that ties into what was just discussed is about what is a better investment in today's market? Is it residential or commercial real estate is a question. And perhaps tied into that would be speaking about some of the fundamentals of that is driving the real estate investment across the Niagara and the GTA region. And perhaps I can start that off with AJ and Shaheryar on that one.
Yeah, I'd be happy to start that off. So, the market fundamentals for real estate is similar to any other commodity. You're going to have your supply. There's going to be a balance between your supply and your demand. So in terms of your demand, you really have to think about what is Canada's population. Right now, we're sitting at 38.6 million people, and it's growing on an annual basis of about 500,000 people per year. In addition to the demand from those two categories, you also have your Canadian and your foreign investors that are also looking to invest in real estate in Canada. So you have a very huge demand for real estate. In terms of supply, or new housing, here's a stat from the Canadian Mortgage Housing Corporation that as of 2021, there were 220,000 homes built. And whereas the population growth is close to 500,000 people per year. So you see there's a huge gap there between supply and demand, which is, causing this price surge that we're seeing all over the place. And also, from a developer standpoint, some of the things that we're noticing is, getting approvals in place takes, quite a bit of time, sometimes 2 to 3 years. And in addition to that, there's also sometimes red tape. There's certain areas where you're just not allowed to build. So, in terms of supply, we're really squeezed tight. In terms of demand, there's a huge demand all over the country. So there's a little bit of a difference here. Now, what Ontario has done is there's an Ontario Affordability Task Force who has recently come out with a report. And what they're proposing to do is double the number of houses being built in Ontario. So in essence, what they're proposing is going from 75,000 houses per year in Ontario and taking it to 150,000 per year. So hopefully that improves the supply-demand offset. In addition to that, market fundamentals. You obviously have your interest rate, your inflation, your GDP. Those are factors that also that need to be taken into consideration as well. Do you have anything to share?
No, I think I'll take the next question.
Wonderful. And I think there was a question from viewers coming in asking the panel's thoughts on whether residential or commercial real estate would make a better investment choice in today's environment.
Well, it really depends from whose perspective you look at that. From an individual's perspective, an individual investor, I think investment in commercial real estate is difficult to access. If you're an institution, then naturally you do have access to commercial. Although my personal view is that a lot is changing in the commercial segment, especially with remote working, less need for office space. Also, retail is sort of redefining itself. So if you are in the commercial space, there are opportunities like in industrial warehousing, cloud kitchens, storage for e-commerce businesses, those types of investments. But I'm quite bullish on residential real estate. Robyn mentioned some really interesting facts about just in the St. Catharines, Niagara region, you see a lot of inflow of people and positive net migration, and also a shortage of housing. So what that means is that we're going to see a lot more development. Interest rates are still low, and I don't believe we're going to see, interest rates above 5% ever in our lifetime. That's my view. And even at that, I think it's a pretty good opportunity to invest in. So yeah, I think residential is where it's at in the next 10 years.
Great, thank you. There's a question here in terms of asking about how do provincial infrastructure investment drive real estate, and if there are any examples that could be provided or spoken to. And I would offer that to one of the panelists here. Robyn.
I'll happily take that. Yeah, infrastructure investments are, massive impacts on development, and particularly transit, I would say, would be one of the major ones. So what you have is around transit stations, the province has instituted density targets. So they're called major transit station areas. And so it's a density of 150 people and jobs per hectare around a GO station. So a GO station that at one point was really in the middle of nowhere suddenly is going to have, through these MCR processes, incredible amount of land use permissions that weren't there, even some places that were industrial. So lands around those infrastructure investments are huge. I think also if you look at the LRT in Hamilton, the LRT in Mississauga, this is going to transform the value of the lands that are around those and the value of the buildings that are around there, because they're going to have to be providing these high density or medium density buildings, and they want a mix of uses with people and jobs. So you're going to get sort of ground floor retail or maybe some office and those kind of things. So, those kind of investments are huge. I think to a certain degree, some highways, whether the GTA West Corridor comes in, that's going to impact some of the values of some of the industrial lands around there, which are already, and I know that we were talking about, land, but I'm very bullish on industrial land, very sought after, a lot of demand because of e-commerce, particularly also urban industrial land where you're doing the first and last mile. But I think definitely when it comes to transit infrastructure, universities, hospitals, those kind of big investments that the province is making, you're going to see a significant amount of growth around those areas.
That's great. So next question here is talking about what are some of the risks which real estate investors should be concerned about, and what might be your advice on mitigating some of those?
So I can take that question. So with respect to a multi-residential developer, some of the risks we face, starting at the beginning stages when you're acquiring your land, you don't know what's in the ground, right, until you do geotechnical and environmental testing. So there's always that risk as in like what you may encounter underground. If, for example, there's contamination, then you have to go through extensive remediation costs, and you have to deal with the Ministry of Environment as well, which could add some time and cost as well. Another major risk that developers face is, from an approval standpoint, you're spending a lot of money on drawings, studies, application fees, and there's really no guarantee of getting your zoning application approved. So, developers really have to take that into mind, that we're investing all of this money, but there's still a possibility that it may not go to their outcome. From a marketing and sales standpoint, developers also face the risk of a market downturn potentially. So, will the project sell for your anticipated sale price? So that's something developers consider. And I guess the major one is from a construction cost standpoint. So, on an annual basis, you have your material, your labor prices going up, and it gets, more and more difficult to estimate the cost of your construction a few years in advance. So developers face that risk. And, when you're doing your pro forma, you really, to deal with all these risks, you may need to increase your contingency. That's one way to deal with it. And the other major way you want to deal with these risks is just to speak to experts in this field, right? Whether it's environmental or marketing people, whether it's the city, you just want to be very informed throughout the stages of your project, so you have a better comfort level. So yeah, I think that deals with that question.
Awesome. So taking that perspective of developers through here, how do you analyze feasibility of a project?
Okay, so in terms of your feasibility for a project, you're going to be doing this at various stages. So when you're searching for a property, you're going through what's called the back of envelope pro forma. At this stage, you're really just exploring your high-level idea. You're considering your advantages, disadvantages. You're making a lot of assumptions. You're just trying to see if the numbers will work out at the end. So then as you get into your due diligence stage, as you're getting closer to acquiring the property, you're going to do a more static feasibility study. At this point, you're going to start refining your assumptions into more solid facts. You're going to try to figure out the costs related to how your works. And you want to get a better understanding of your highest and best use for the site. So, for example, whether you want to do residential, whether you want to do commercial, or whether it's a mixed-use project is best served on that. And, there's still some guesswork required at this stage with respect to your revenue, money coming in, timeline, and your overall cost for the project. But as you get closer to your acquisition, you want to do a more proper, thorough cash flow feasibility study. Now, at this stage, you want to start diving into the details, especially around financing and your funding requirements. You want to understand how much money you will have coming in and how much will be going out. And really, at this stage, you want to just make sure that the project makes sense before advancing and investing all your time and energy into it. So I think, you're analyzing the feasibility of a project throughout its life.
So a question coming in from those who are watching and that's asking about, how do you forecast the housing market in the coming year, or in the this and next year in particular? Are we anticipating that the rise would continue, or would there be a correction in the market?
I mean, I guess it depends if you're talking about the resale market or the new market. I think those are two very distinct things. I think, I think that most of the stuff that is being currently built is already sold. You know, generally projects are not built before they're at least 70% sold. And I think there's definitely latent demand and a sort of a backlog of demand. So I don't particularly see it slowing down. I think also as immigration opens up again post-COVID, you're going to see, you know, incredibly, you know, this unmet demand. And as mentioned before, you know, the supply is not meeting the demand. And that's my stat on it. I don't know, maybe some of the other experts have thoughts on that.
Yeah, I mean, I would add what AJ mentioned, the Ontario Affordability Study. You know, you can employ a political angle to it as well. So if we have, let's say we have elections coming up and the Conservative government gets elected and they employ the findings of the study, which will make a lot more land available and feasible for development, that would increase about the supply in the housing market. So that could be one position you could take. If it's not the Conservative government, then you don't know what the agenda of the Liberal would be. So, you know, you could tie that factor into it as well. And I think, you know, when you're forecasting such things, you know, you would look at sort of expected housing starts, your forecast of interest rates, and then also net migration as well. How many people are moving into different municipalities, and also the master plans of each municipalities, how much development they expect to have.
And just to add to that, actually, Abdul, you know, what I would recommend is for curious minds out there, really to do your own research. You know, you want to understand what the market is like, what's really driving the economy, what's driving the real estate market. You know, as mentioned before, it's the supply demand. You have your interest, you have your GDP growth. These are all things that people should take into account. And there's useful resources. If you go on Stats Canada, you can look up all this information. There's the Real Estate Association. So, you know, just research online and, you know, make up your own opinion too. You know, I recommend that for a lot of people.
Wonderful. Yeah. This next question builds on, go ahead, Earnest, please.
Yeah, just a very minor comment. Simply just maybe it will be useful for viewers. Yeah, you also have to realize that there is no such one thing as the real estate market. It's a real estate market is very specific to your area. Like, for example, right now, if you look at the Niagara on the Lake, I think the average price of the house is more than 1 million. And I think it's almost peaked because I did not see significant increase in prices. So I think you have to really see, so real estate market is very specific, really local. So you really have to see what drives the housing prices in that particular area. And also, and simply just, we all realize that actually right now inflation keeps going up. So the Central Bank of Canada definitely is going to increase the interest rate and already started to do that. So potentially it can put some pressure on the, again, on the borrowing cost, and potentially it may affect the demand for the house prices, okay, for houses. Thank you.
Excellent. So this next question ties into this, and it's asking you to dust your crystal ball even further and looking at 4 to 5 years. What kind of trends are you anticipating to see in the market? And this is someone who's taking the perspective of a first-time buyer, and they're making a statement here that the real estate houses are inflated currently, and will they continue? And what advice might you have for a first-time buyer? Should they go in, buy, wait? What other strategies might be up the sleeve that could be offered for them?
Okay, so I can just quickly chime in. It's a very difficult question to answer because it depends on what geography and what your perspective and motive is as a real estate investor. I'll give you a case in point, okay? I recently invested in Miami. And I believe that to be a real estate investor, you got to be a big picture and patient investor. Okay, so I looked at, this is exactly what I looked at. I looked at over the next 4 to 5 years, what will happen. I got interested in Miami because I found that during the pandemic, there was this big sort of FOMO movement. People in the Northeast started getting really upset with the weather and wanted a better quality of life. There was a lot of migration happening south, sunny weather, and companies, especially smaller companies, picked up quickly and said, we can allow for remote working, work out of there. So, okay, I saw that there was going to be this sort of population growth or net migration within Miami. So let's start looking at the city. And then as you're looking at a particular area or city, so you look at, okay, you start getting more technical about which areas. So when I went there, I saw there was South Beach, which was very touristic, very high price point like Niagara-on-the-Lake. There was Brickell area, which is downtown Miami, linked to downtown, and there's West Road, which is sort of the artsy neighborhood. So for me, I found that a lot of these people that are moving from the Northeast are going to probably settle in the downtown Brickell area, which is more familiar to downtown settings, where there's office space, commercial, good access to transit. And then I took a position that, you know, if you buy a luxury product there in pre-construction, that you'll see not just price appreciation, but also appreciation in rents. So I looked at the current rental yields, which are $4 to $7 per foot. And the projection was that in 3 to 4 years, it would be well above $10. And then I did my math in terms of looking at what my cost would be. That is taxes. And Miami, state of Florida doesn't charge you federal tax. State tax. You don't pay federal tax. I looked at the condominium fees. I looked at what the mortgage payments would be, depending on forecast the interest rates, which I don't believe will ever go above 5%. And you know, it turned out to be, from my math, that it would be a fairly good investment. Now, you can, you know, my view is that you can get more pedantic with your analysis. You can start looking at correlation, oil price inflation, GDP, this, that, and the other. But at the end of the day, it's a 20-80 rule that I employ, that 20% of your analysis will constitute 80% of your decision-making and value creation. So again, you got to look at the big picture, broad strokes. Okay, are you seeing, you know, positive net migration? You think there's going to be demand in this market? Is there going to be employment opportunities? Are you buying from a reputable, good developer? Are you able to seek financing cheaply? And yeah, so I hope that answers the question. I'm sorry I took a little spin on it, but yeah.
I can add a little bit about some of the trends I'm seeing. I think climate change is very important and resilience. So I think you're going to see investors considering that when they look at buildings for long-term holds. They're going to be looking at sort of, you know, you see the flooding that happens as 100-year floods become more common. As energy prices increased, is the building energy efficient? You're also seeing a rise in what is called the 18-hour city. So instead of the Torontos, the Montreal, and the Vancouvers, you're seeing a push to these cities that aren't go, go, go all the time, but are still very vibrant. So, you know, the Mississaugas, the up and coming, where you're seeing a lot of growth. The Sun Belt in the United States is considered now one of the biggest buys for, you've got people locating. It's not quite Florida, but it's an interesting sort of trend where people are moving. So I think thinking about also geography in a broader sense about where is a good investment, where is going to be a future vibrant city, again, transit investments, other investments. I just attended something about San Diego redeveloping their stadium, and you know, these massive projects that have opportunities to build very new community. Downsview in the city of Toronto is going to be an incredible possible investment for a home buyer, because it is going to be such a unique, modern, you know, climate resilient sort of community. So those kind of things to think about as we move forward, and you're looking in a 40-year investment. This is obviously not quite the same as buying a condo, and you've obviously done incredible research on your investment. But when you're looking also about sort of where's a place you'll want to live, where's a place that people will want to live later in life as time goes on, I think those are things you also need to consider.
Excellent. So perhaps time for one more question as we're approaching the end of our allotted time here. And building on the theme of the USA, and rent to own is something that's more common down south of the border than here in Canada. So the question here is, when a person begins to rent a property in 2 years, does he have the right to buy it out at a special price, or what advice would you have for those who are looking to explore the rent to buy route as well?
Well, you know, we don't have any example of the rent to own in our developments, and I don't believe that it's quite a common practice, although it should be, given that there's such a big housing shortage in Canada. Interest rates are so low, and house prices keep going up, and you know, it's that thing about rich keep getting richer. So we need to, I think we need a lot of work from municipal governments, provincial and federal governments to make such policies where and make home ownership more accessible. You know, I mean, you can get financial institutions involved. There's a lot of work that needs to get done in Canada to address it. It's a really serious problem, you know. And I think it's a real shame that we don't have much going on. We also have, we've experienced that, some of the development that happens, it's so slow moving. We're one of the slowest sort of approval processes in the world, given the housing shortage. Having said that, I do admire the fact that our cities are so well organized. There's, zoning laws. There's a lot of respect for different constituents and stakeholders. But I think, again, when it comes to homeownership, it's an area we're really falling behind. And affordable housing is going to be a big policy agenda for governments that are going to come to power here over the next few years. I'm not sure if that quite answers the question.
I think it would take a certain type of developer. I think you need an institution involved in that who would be willing to take on the risk and the initial cost. I mean, there's a certain amount. Rental housing, particularly with development levies, can be quite expensive because it takes you a longer time to collect on those. So I think, I think you're right. It's been a slow process, and I think we'd have to have a really significant rethink about how that would work. It also has a lot to do with our land transfer taxes and a whole bunch of things that would need to be rethought to make that make sense for a lot of builders. But it's certainly a great idea, and I think you're right. The United States has embraced that in many ways better than we have.
Wonderful. Thank you very much. We are approaching the end of our scheduled time here, and there are many questions that are still outstanding and coming through. So our apologies to our viewers for not being able to get through all of those during this part, but we'll do our best to answer those outside of this session. I also want to extend my gratitude and thanks to our panelists here who have taken time out to be here to present on this topic and share with us their thoughts. So thank you very much, everyone, indeed. Goodman Group is a community-focused learning and development services provider that works to support professionals, businesses, and entrepreneurs who are focused on improving their professional development through offering professional development certificates, executive education, consulting services, and support for our startups here on campus as well as within our communities. Goodman Group is pleased to share a number of new programs that we have on offer, in particular focusing on the newly arrived Canadians and those who are looking to bridge their internationally trained certificates and experience and education into Canada. We're also pleased to offer with you the Professional Leadership Development Program, as well as our specially designed nonprofit leadership development program. Information for all of this is available through our website, and registration is open for all of those items. I do want to once again thank our viewers and our panelists for being here and for speaking, and also for those who posed their questions. Thank you very much again. Next session of Business Breeders is in April, and we will have Tim Arnold, who will be talking about his new book, The Leading with And. I hope that you can join us then. Until next time, stay safe.
Bye.